Let's get straight to the goods. Let's get straight to the meat. We have B.A. Harris. Guys, for those who don't know, B.A. Harris, it has been, I got connected with B.A. Harris and Aaron and Arla through Swope Investment Properties. And they've been doing my accounting, and they've been great coming out to AVID and sharing really helpful information each year. So Aaron is here with us. He also has with him TJ, Matt, and Madison, and possibly even Carly. I didn't from BA Harris. So Aaron, take it away. Welcome.
Yeah, thanks for having us, Stacy. Hi, my name's Aaron. So I've been with BA Harris for a little over 6 years now, and I've been coming out and doing this presentation for about 6 years now. So typically I would come out with Arla, one of the partners at our firm, and she's actually semi-retired now. So now I'm leading the charge, and I brought along Madison, TJ, and Carly, because if you know anything about accountants, we all just love public speaking and whatnot. So I thought I would bring along the crew with me. I just wanted to say thank you to Stacy for having us. I'm always super impressed at the product that she puts on here. I don't know how you can talk for as long as you do and so clearly. It's always super impressive. And whenever I'm watching that market update, I always think to myself, man, if I didn't have 3 kids in daycare right now, I'd be swooping up one of those fourplexes for sure. But that's just it's a little dream of mine right now. But maybe in a few years we'll start thinking about that. So no one will ever accuse me of being a salesperson, but I guess I should talk about BA Harris a little bit. BA Harris was founded in 1998. So we've been serving the Treasure Valley for about 25 years now. Over the past 6 years from when I started, I was the 7th member of the staff that was hired on. This busy season, we're going to have up to 30 people working at the firm this year, helping us out with this filing season. So we've experienced your growth over these past few years. We were named the best accounting firm in the Treasure Valley by the Idaho Business Review in 2023. So we were all really excited about that. And Stacy wanted me to point out that we've recently added a client accounting and advisory service department, which they assist our clients with full bookkeeping services and payroll services if those are required. They've been a great addition to our firm, really freeing up. So I'm on the tax end of things. I'm a CPA. So my expertise is more preparing tax returns and giving tax related advice, not so much actually getting into the nitty gritty and doing the bookkeeping. So it's great to have them on our team. And if anyone is interested in reaching out to us or to our CAS department, certainly, I don't know if Stacy, if we're doing like an interactive chat or something like that, feel free to leave your information in the chat or reach out to us, and we'll certainly get back to you. As Amberly was discussing earlier, thinking about getting in here and taking kind of a long-term view of things. The presentation we're gonna touch on, we actually spoke about last year. It's a way for you to work around this $10,000 state and local tax limit on your tax return by utilizing partnerships to file tax returns for your rental properties. This may not apply to everyone, but we're hoping that everyone gets the income level where they can take advantage of some of this tax planning advice that we have. We're also going to give you an update on the tax deduction changes for 2024. We're in the middle of a administration currently. There was no election from 2023 to 2024, so things are pretty much static for the most part, but there's some things we wanted to bring to your attention. And there's also a fun little surprise that I'm not sure many people have heard about for the very last slide, so stick around, and we're gonna knock your socks off with that one. So I don't know if you want to screen share, if I can screen share this or how.
Yeah, you should be able
Hopefully
to.
this works. let's see here.
And I love the little surprise carrot that you dangled out there for
Well,
us. I'm
we'll
interested.
see how excited it makes people, because it's kind of a scary surprise, but we'll see. Let's see if I do this one. Oh, here we go. Screen 3. Am I screen sharing? Is this working for
Yes.
everybody? Are you seeing BA
Yes.
Harris on the? Okay.
Yes.
Awesome. Okay, so let's go to slide 2 here. Okay, so this state and local tax limitation workaround. So let's go back to 2017, 2018. President Trump gets elected and passes this Tax Cuts and Jobs Act. So what this does is it limits the deduction for state and local taxes on individual returns to $10,000 while raising your standard deduction. So prior to 2018, if you paid over $10,000 between your property taxes, your withholdings on your W-2s, and you itemize, the sky's the limit. You could deduct as much as you wanted. There's no cap. Well, they limited those deductions now to $10,000 if you itemize, and the way to make this revenue neutral was to raise the standard deduction. So the standard deduction for someone who's married filing jointly on their 1040 was, I think, like something like $12,000. They doubled it to $24,000. So they're basically giving everyone who's married filing jointly an extra $12,000 of deductions off of their taxes. So in order to make this revenue neutral, so obviously the IRS is losing money by raising the standard deduction, they cap those state and local tax deductions at $10,000. So this results in a lot of taxpayers losing out on federal tax deductions that they had previously received, and it completely barred other people from itemizing on their taxes altogether. You think about people on, from California or New York who are just paying a ton in property taxes. Those didn't have a cap, so they were paying tens of thousands of dollars in property taxes, so they can itemize. They're getting those deducted off their tax returns. It's a good deal for them. Well, now they're capped at $10,000. Some of them aren't even itemizing anymore, so they're stuck at, instead of deducting $30,000 off of their taxes for itemizing, they're stuck at that 24 if they're married filing jointly. So they're losing out on $6,000 of deductions. They also removed 2% unreimbursed employee business expenses. So it used to be, if you were a W-2 employee and you had an expense that you didn't get reimbursed from your business, you could deduct those expenses if you itemize, as long as they were over 2% of your adjusted gross income. So the example that I always use is from the movie Shawshank Redemption, when all of the guards are going in and having Andy do his tax returns, and he's talking to the guard, and he's like, "Oh, you had to buy that holster? Yeah, that's a deduction." So it's something like that. Those are gone now too. So there's a little bit of give and take. Everyone's thinking, "Oh, it's great, I get this big standard deduction now," but they also have to lose out on something to gain something with the IRS. So in November of 2020, the IRS releases Notice 2020-75 that says state and local income taxes imposed and paid by a partnership or an S corporation on its income are allowed as a deduction in computing federal AGI, and thus are not limited by the SALT cap. It's basically saying, if you have a partnership or an S corporation, that partnership or S corporation can pay the state tax that is generated to its owners and can deduct that payment at the federal level. And I know I'm throwing a lot of jargon at you. I have a pretty nice case study that I think is going to help people figure out what's going on here. But just because it's accepted at the federal level doesn't mean that it's necessarily accepted at the state level. Every state needs to agree to abide by this rule. And you'll see a slide that TJ is going to present later, shows not every state still is abiding by this. So 2020, that's released, the IRS says you can do that, but it's not until 2021 that Brad Little signs House Bill 317, basically okaying it, saying that you can actually do this workaround. So the bill permits Idaho state taxes on Idaho source pass-through income, entity income, to be taxed at the entity level as opposed to pass-through to entity owners. So basically, now we're saying, if you have a business that's making a ton of money and it's passing through a ton of, or causing your shareholders or partners to have a lot of Idaho state tax on their individual returns, the business can now pay it and deduct it at the business level. So hopefully this is making some kind of sense. We actually went over this last year, but I really wanted to hammer this home because we had a ton of questions about this last year. So hopefully this is getting through to some people. I mean, it's hard enough for us as professionals to understand this stuff sometimes. So I can totally understand if this is kind of going over some people's heads. So,
and so far, Aaron, so far you said that those laws allow the income tax to be deducted if it's paid, the Idaho state and local income tax to be deducted.
So state income taxes, right, generated by the entity, as long as it's Idaho sourced. Okay. So just, I'm getting a little ahead of myself here, but let's say that you're an Idaho resident and you have a business, but all of the income is derived in Washington, right? That's going to be taxed at 0% because it's well, actually, let me hold off on this. Let me I have an example that I think will clear some of this up. I'm getting ahead of myself, getting in front of my skis. I'm just so excited to talk about this. So this is how the deduction works in Idaho, and I underlined Idaho because every state is different, as TJ is going to talk to us about later. So an annual affected business entity election needs to be made on a timely filed original return for the taxable year and is available only for S corporations, partnerships, and LLCs taxed as partnerships, trusts, and estates. So you can't amend returns to make an ABE election. So if you're hearing this presentation and you're thinking, oh, I don't think I've been taking advantage of this. It's been available since 2021. Let me look back at my partnership returns. Have I been doing this? And you haven't been, it's too late. So 21 and 2022 have already been filed. It's past the extended deadline. You can't go back and elect to be an ABE at this point. So a pass-through filing its first tax return can make an ABE election by September's extended due date, but you have to pay in 80% of your ABE payment by March 15th. So for example, let's say this month, I want this to be the first time that I'm doing this and I have a partnership return. My wife and I have a rental property that we hold in a partnership. It's held by an LLC. And I'm hearing this presentation and I'm thinking, oh, that sounds great. We make $100,000 in net income. That'll be $5,800 of Idaho state taxes that we can deduct. We'll have, if we want to do this, we have to pay in at least 80% to the state of Idaho by March 15th in order for this to qualify as an affected business entity. So if you've done this in a prior year, so if in 2022, my wife and I filed as an ABE, you have to pay in at least 100% of last year's liability. So last year, our liability was $6,000. In 2023, for 2023's tax return, we have to either pay in 100% of 2022's tax or 80% of our current year tax liability for this election to be valid. So there's a lot of tax planning that goes into this, and you have to kind of be on the ball or you're going to miss these deadlines and it's not going to be an official election. Once you make the election, it's irrevocable for that tax year. So once you go ahead and you make your election to be an ABE, you have to follow through with it. It's what's done is done. The entity electing ABE status will be responsible for paying the Idaho state tax, resulting in a deduction to its members' income at the federal level for the taxable year in which the payment was made. So TJ will go into this in a little bit further detail, but basically what that's saying is, to go back to my example, say I have a rental property in Idaho that made $100,000 in net income in 2023. That results in Idaho state taxes of $5,800. If I want to be an ABE and I want to get that $5,800 deduction in 2023, I have to make that payment by the end of 2023 for it to be deductible in 2023. If I make that $5,800 payment after year end in 2024, as long as I make it before 3/15, I get that deduction, but it won't be deducted until 2024's tax return is filed. So basically, you get the deduction for the year in which the payment was made. So as I mentioned before, planning and being on top of things is absolutely critical if you want to work out the timing with this thing. Members of the pass-through entity will also have their pro rata share of Idaho taxes paid flow through onto their individual Idaho state tax return. So I think there's actually a better example of this on my next slide, and hopefully this kind of clarifies some of this out for everybody, because I know this is a lot of numbers. So here's the case study I was talking about. So in 2023, a married couple earns $150,000 in W-2 wages. So my wife and I'm a CPA, my wife's a physician's assistant. We both make $150,000 in W-2 wages. And we also have that rental I was talking about that in Idaho, in the state of Idaho, that's making $100,000 in rental income. We report that directly on our Schedule E. So I don't know how many of you are familiar with your 1040s, or you've taken a look at them. If you have someone prepare them and you're just happy that they're out the door, maybe some of you have never looked at them before. But if you don't have a partnership return or something like that, you'll report your rental income on what's called a Schedule E, and it'll basically show you your rental revenue and your rental expenses, and it'll spit out your net rental income or loss on your Schedule E. And that's just a schedule that's on your 1040. It's reported on the front page of the 1040. It's just basically a supporting document. So between our state withholdings on our W-2s and the property tax on our primary residence, we of course run up against the $10,000 state SALT limitation. I mean, if you're a homeowner in the Boise area and you have W-2 wages, you're going to run up against that $10,000 limit pretty quickly, with the way that property taxes continue to rise around here. So we won't receive any deduction for that $5,800 in state tax that we'll pay on that rental income. So as I said before, we make $100,000 in net income from our rental. Idaho state taxes are 5.8% in 2023. So that $100,000 in net income produces $5,800 in tax that we're going to have to pay on our state tax return from that activity. We're already butted up against that $10,000 deduction limit. So all that $5,800 that we're paying to the state of Idaho, we get no tax benefit for paying that tax. Instead, what we can do is we can file a partnership return, assuming that our rental property is held within an LLC. We can file a partnership return and elect ABE status for the partnership on a timely filed return. And we can just elect to have the partnership pay our $5,800 ABE payment prior to year end. The $5,800 of Idaho state tax generated by our rental is now deducted from our federal income, saving us $1,276 in federal taxes. So on our on our 1040, instead of reporting $100,000 in net income, we'd be reporting $94,200 because we're paying that $5,800 and taking it as a deduction. So instead of paying tax on $100,000 at the federal level, we're only paying taxes on $94,200. So that's going to save us $1,276, assuming we were in a marginal rate of 22%. On our Idaho return, we'll still be taxed $5,800 on the full $100,000. So you don't get a deduction at the Idaho level. So Idaho will still report $100,000 in rental income, which results in $5,800 in tax. But since we've already paid that $5,800 at the business level, we get a credit of $5,800, wiping our tax out to zero. So basically, there's no downside in doing this, assuming you have enough income to justify it. So what can you still do for 2023? I don't know if any of you, if your heads are spinning. I know the first time I heard about this, my head was kind of, swimming myself. Contact a tax professional as soon as possible. Highly recommend that you do this. For existing partnerships, confirm if you have another CPA or an accountant who's handling the filing of your partnership returns. Confirm that your tax professional is familiar with state tax deductions available to you. You'd be surprised. In 2021, it's kind of understandable because it was so new that tax professionals were missing this. But we're still getting returns from new clients, and they bring us their 2022 returns, and they're not getting this deduction. So, a lot of people are coming from, maybe the state of Washington where they don't have income tax. I know one of our new clients is coming from Florida where they don't have income tax. They're just not really that familiar with this, because why would they need to be? There's no income tax in those states. So be sure that if you're working with a tax professional that they're making this election for you. If you've been filing a partnership return,
I'm sorry. There's a question in the chat. So,
sure.
yeah. So Kyan was asking,
Okay.
yeah, doesn't understand how.
Yeah, sure. So let's go back and hopefully this will clear this up. So, so I have the rental property and it's creating $100,000 in net income. Okay. That $100,000 of net income for that rental property will cost me $5,800 because the Idaho state tax rate is 5.8%. So 5.8% of $100,000 is going to be $5,800. You pay that $5,800 at the business level. So you're basically, TJ actually has a slide about this as well. You actually go on to the Idaho state website and you basically pay an estimated payment. You say, I know I'm going to be charged $5,800 for this $100,000 in net income. I'm going to prepay it basically to the state of Idaho. Here's my $5,800. Okay. So then you go and you file your tax return. Idaho is still going to say that you had $100,000 of net income from your rental property and still charge you $5,800, but you get a credit because you've already paid it in through the state of Idaho. So your tax is still $5,800. You just already paid it. So it's going to report $5,800 of tax. And then underneath it, you're going to get a credit for $5,800, which wipes that tax out to zero. So that's basically how the tax gets adjusted to zero.
That's the part I don't quite understand is you paid 5,800, right? And then you get a credit 5,800, which means at the end of the day, you pay nothing.
No, so you pay the state $5,800. And
As
then
a
on
business, on your
it's
business entity, but on your personal return, you don't show that your income has been reduced by that amount, right? What you are talking about.
your federal net income will be reduced by that $5,800. However, for your Idaho state tax return, that $5,800 that you deducted off of that 100,000 gets added back. So on your state tax return, it'll show the 94,200, and then you'll actually have to add back the 5,800 to get you back to the full 100. And then it'll be multiplied by your tax rate of 5.8%. So your tax return will say you owe $5,800, but you get that credit back saying that you already paid $5,800 to the state. So your tax generated from this activity your tax due will be zero because you already paid it through the state.
Oh, okay. So basically you two returns. One is the Schedule E, that's business, you paid 5,800, but on your personal state return, you pay nothing. Basically.
Yes, exactly. You'll basically pay the tax through your business, prepay it, and then you'll get a credit for it on your tax return, which will just wipe that amount out to zero. So you pay it early through the business, so you don't have to pay it later, basically.
Okay. I will leave my question at the end. Well, you continue.
Oh no, it's fine. No, I'm sure there are many other people who are wondering the same thing. So
yeah. And in my case, we have quite a few rentals over the year. We both work and now we retired, and we have several entities, right? These rentals are held in the name of the entities, but they are all passed through for tax purpose. So either the gain or loss all coming to the bottom line of personal return. So I'm guessing we are not utilizing this policy, or if that's the case.
So are you reporting these entities on their own tax returns? Like, are they being reported on partnership returns, or are you reporting them on your Schedule E?
I think they are on Schedule E, pass through at the end of the day.
Yeah, so if they're being reported if you're reporting your properties straight onto your Schedule E, you can't do this because it has to be paid through a pass-through entity. I mean, your Schedule E passes through to your 1040, but it has to be its own entity that's filing its own tax return. Your Schedule E is just a supplemental schedule that goes along with your 1040. It has to have its own partnership return to do this, to take advantage of this. And we actually are going to touch on like how you can take care of that. Actually the next slide, I think I was going to discuss that.
Okay, well, thank you.
Yeah, no, absolutely. If anybody else has any questions, I'll do my best to get them answered. So for 2023, where was I? Yeah, so if you're married with a rental held within an LLC, kind of like we were just speaking about, you can still file a 2023 partnership return and make an AVE payment, which will be deductible in 2024. So as I mentioned before, you make those AVE payments prior to year end, you can deduct them on the 2023 return. At this point, if you make them prior to 3/15, they're only deductible they will be deductible, but not until 2024. You'll need to go online and apply for an EIN through the IRS website. Super easy, super fast. You get it instantly. And this option is unavailable for rentals that were not held in LLCs by year end 2023. We've done planning for people before, and they want to take advantage of this, so we're basically rushing at year end to try to transfer properties into LLCs before year end. Just a reminder that if an AVE election was made in 2022 and the plan is to extend your 2023 partnership return, either 80% of 2023's AVE payment or 100% of 2022's AVE payment must be made by 3/15 to have a valid Idaho extension. If you miss that deadline, then you cannot be an AVE for 2023. What can you do? Oh, go ahead.
Sorry about that. For that income, is that net income or just the rental income before deducting all depreciation, the mortgage?
Net
or
income.
other
Yep. We got a slide about that very specific thing, I think, on the very next slide. So you're ahead of the game.
Thank you.
No, I love it. So what can you do for 2024? Similar to 2023, make sure you contact a tax professional. We really want to hammer this home. This isn't really something that you can do as a novice tax person. You definitely want to have professionals on your side getting this taken care of for you. As I said before, planning is key to maximize this deduction. Like I said, if you want to have it deductible in the current tax year, you have to make it prior to year end. One planning technique is what we call a master LLC. So let's say, for example, you have multiple properties on Schedule E's and they're all held in separate LLCs, as I know a lot of real estate investors are want to do. Basically, what you can do is you can take a look at your Schedule E's and see which properties have decent net income, and you can basically transfer all of those properties into a partnership, create all this net income, and then take the deduction through that master LLC. You're going to want to meet with an attorney to aid in quit claiming the properties into LLCs and to confirm that all state requirements are met. And now I'm going to hand it off to Madison. Madison, is your computer working? I know we were having a little bit of issues earlier. Check. Madison? Can you hear me? Are you on mute? Okay, well, I think maybe she's.
I'm checking the participants right now, Aaron, and as I do, we have had a few requests. Yeah, Madison is here and she is on mute.
Okay.
While we've had a few requests for the presentation in PDF form, so I'm not, if that's something that you can send, so I can share it with folks.
Yeah,
that
absolutely.
would be great.
For sure.
Yeah, and they said after is fine. It doesn't have to be now, but this is helpful stuff. So
can we unmute Maddie, or is that, she said she's having trouble unmuting?
I just clicked ask to unmute, but it didn't work.
Okay. All right, well, let's see, she's typing. All right, well, she said she's having some trouble with this. I'll just go ahead and I'll forge ahead and just cover her slide for her. She worked really hard on this too. So
okay, hello, can you hear me?
Oh, hey, there we go.
Yes.
Hello.
All right, she didn't want me to steal her thunder.
Yes.
Can you hear me?
We can
hear you, Madison. Can you hear us?
I think my computer froze for a second because it wasn't letting me unmute the audio for some reason. but I'm glad it's working now.
All right,
Okay,
Maddie, are you ready?
I'm ready.
All right, so Maddie's going to talk to us about what we should think about before we start forming our own partnership and jumping into this.
Okay, so everything that Aaron was talking about probably all sounds super great, which it really can be for some people, but there are some things that you should consider before forming a partnership, whether it's going to be beneficial for your situation or not. So the first thing that you should think about is if your rental is consistently producing net income. So state tax is only generated on that factor. So only rentals with net income can take advantage of a state tax deduction. So if you're at a loss on your rental properties, or if your rental does create a lot of net income, but you're expecting some major expenses on the horizon that's going to offset that income, now may not be the best time to form a partnership due to the potential net losses. You're not going to be able to see or take advantage of that state tax deduction. The next thing to consider is where your rental properties are located. So there's currently 9 states with no state income tax, and an additional 6 states that do not conform to the state tax deduction, which TJ is going to talk more about later. But if you have rental properties in these, you're not going to benefit from being formed into a partnership because there's not going to be any state taxes to deduct. So if you have a bunch of rental properties in Washington, they don't have state income tax, it might not make sense for you to pay the cost of forming a partnership because you're not going to be able to deduct those anyways. The next thing to consider is the costs in forming a partnership and filing a separate return. So if you do form a partnership, you do have to file a completely different return for that partnership, separate from your 1040 or individual return. And so if you have a rental property or properties producing a low amount of net income, this may not be a cost-efficient decision when considering the accounting or legal fees that are going to be related to forming that partnership, and then also filing that separate return. So let's say you have a rental in Idaho. After expenses and everything, you're producing a net income of around $10,000. You're going to receive a state tax deduction of $580 in 2023. And that's going to result in tax savings of about $128, assuming you're at a 22% federal tax bracket. So once you consider the cost of paying someone to do your return, the legal fees, and forming a partnership, you're really not going to see that state tax deduction benefit. It's probably just going to cost you more. So that's definitely something to think about. However, if you currently already have a partnership that's holding your rental properties, it's almost always going to be beneficial to be an AVE entity. So you can look at your prior year partnership return and see if you elected to be an AVE entity from there. If you haven't, I would definitely recommend talking to your accountant or whoever prepares your returns about getting involved in that, as that would be beneficial for you in that instance. Okay, I think I'm going to pass it over to my colleague TJ. He's ready to go, and she'll kind of dive into more info on this.
Okay, so we're going to talk a little bit more about how the different states look at this. So as Maddie mentioned, there are 9 states that do not have an income tax. And those are the ones that you see here in gray. So if you primarily have your rentals in the gray states, then this isn't going to benefit you. And then there are 6 states that currently don't recognize this structure. And so again, those are the yellow and the white states. If your rentals are there, there's 3 states that like basically don't have it even on their radar, 3 states that it's on the radar, but it keeps getting pushed down the pike. So we really don't have an idea of when that might happen, and this is going to sunset at some point. So that kind of gives you the map so you can look to see if your rentals are in those states and how that might impact you. So next, we're going to look at how the different states format their version of this. So it's interesting that when you start working at BA Harris, one of the first things we do is give you a list of all the acronyms, right? And so we've already thrown a whole bunch of acronyms at you, and I'm going to throw one more. So we've been talking about an AVE election or an AVE election, and that is what the state of Idaho calls their pass-through entity tax strategy. So when we talk about a PTE, or you'll sometimes see it referred to as a PTET, that is the same as an AVE, but an AVE is specific to Idaho, whereas on this slide, you'll see PTE. It's the same thing, it's just how the different states apply it. So I've got it charted out here, and you'll see across the different states, and these are just some states that we chose that are really common for our clients and possibly for you to have rental properties in, to look at some of the differences that we have amongst the states. So I'm just going to go through them one by one. So in Idaho, as we've discussed, the annual election must be made on a timely filed return, and it is irrevocable. And then what's key with Idaho and what's great is that if you overpay, it can be refunded to you or it can be carried forward. So you still have the opportunity, even if you overpay, you can still utilize those funds. In California, the annual election must be made when the tax return for the taxable year is filed. The PTE, which is the entity, must make an initial payment of the greater of $1,000 or 50% of the elective tax paid in the prior year by June 15th. So in order to have this valid election, those are the parameters that you need to meet for the state of California. And then the remainder is due at the time of filing. With California, the overpayments, if you do overpay, they are carried forward for 5 years, but then they expire. So if you overpay by too much, and again, you still have to meet this $1,000 and 50%. If sometimes you can continue to accrue those overpayments, but after they're on their books for 5 years, they're going to expire. And I just want to point out that at the bottom, you'll see there's a reminder that the federal law only allows for a PTE deduction for the entity in the year paid, and it cannot be accrued. So where you're seeing that California says that you don't have to pay until June 15th or until the remainder is due at filing, you can absolutely pay those, and they'll be deductible from your entity when they're paid. If you want them to be valid for the tax year, and right now we're doing 2023 taxes, so those had to be in by December 31st, even though the state of California says that they could be later. Again, so now onto Oregon, there's an annual election that is made on a timely filed return, very similar. They do allow a revocation of the election for a tax year if it's made on or before the due date for the tax year's PTE return and if all members consent. So Aaron said that, in Idaho, it's not revocable. If you say you're going to do it, you have to follow through. Oregon, you can reverse that. And they will refund you the amounts that if you say I'm not doing it, then they will refund that to you. The PTE must make estimated payments following the personal filer dates. So you're probably pretty aware of if you're making estimated payments, it's kind of quarterly, but not quite. Otherwise, they're going to get charged underpayment interests, and the overpayments are refundable. So again, if you give them too much money, they're going to give it back to you. Utah is quite a bit different. They have the election is treated by making an electronically filed SALT report and submitting as the SALT tax payment. So again, the state and local tax payment on or before the last day of the PTE's taxable year. It's very important to note that no late payments are accepted. So if you underpay, you can't pay it. It's like kind of like you have to pay it or you lose it. And then again, the overpayments are carried forward 5 years and then expire. So Utah's really finicky about making sure that you don't overpay, but you don't underpay. So that's where tax planning is really very important. And then the last one that I have on here is Arizona. And you'll see the annual election again is made on a timely filed return. And I didn't include tax rates for the other states. As we know, Idaho is 5.8%. Some of the other states are usually around 9%. Arizona's only 2.98%. So we often find with our clients that have rentals in Arizona that this election is one of the exceptions where maybe it doesn't make sense. Maybe going through this is more hassle than it's worth because of the low tax rate. But individual partners and shareholders may opt out. So that's an interesting part of their system. Partnerships and S corps making the PT election whose taxable income for the previous year exceeds $150,000 are required to make quarterly payments. So if it's under that, you don't have to make the quarterly payments, but it's over that, then you do. And then the next, we're going to look at the process for paying the ABE payment for Idaho. And all of the states have a process, and they're relatively easy to find. If you just Google California PTE tax, it's pretty quick to find information. It's not necessarily pretty quick to understand the information, but a lot of times you can find these portals. So if you're feeling really confident with it and you have a state that you want to go out and look into, you can always reach out with questions. But you can look to your tax provider, or we would love to bring any of you on as clients. But it's pretty easy to get that information and to find these websites. But I wanted to just kind of show you Idaho's so you get kind of a feel for that. So in Idaho, we have the TAP portal. It's the taxpayer access point. And so you go to that, and when we will send Stacy these slides, and I will throw that link. That is a link, but I'll put the actual website into the presenter notes so that you have that.
Yeah, Stacy, I emailed you a PDF copy, by the way, like a few minutes ago.
Great. Thank you so much. I'll get that out to the folks who are asking. I've had a couple requests so far. Anyone else, feel free to message me and I'll make sure you get it. Perfect.
One of the great things about Idaho's system is that you don't have to sign up to have an account to be able to log in. There can be quite a bit of rigmarole to get that to happen. But to pay this payment, you don't have to do it. So you can just go to the TAP portal, and then you'll see, I have a little screenshot of the payments section that you would see there. And you just click on the make a quick payment link. And then that's going to open up this taxpayer screen. And so this is the information that you would want to gather in the second screenshot that you would want to gather and have available so that you can input that. And if you are receiving a voucher from us or from your tax professional, then the voucher would have all that information on there for you. And then when you've filled all of that in, it opens up another window, which is the account information. And this is what we have filled in here is probably what it would look like for most of your situations, that it would be, the business income tax, and that it's an estimated payment. They don't call it an ABE payment on this screen yet, but that is what it is. And then most of you would be filing a partnership annual return with the end date of the end of the year. And so there's detailed instructions here. I'm not going to read all of them to you, but that you could follow, and you would be able to make this payment and get it all taken care of for you. And again, be sure to make a copy of the payment so that you can send that to your tax professional. And if you are looking for one, we would love to help you. And now I'm going to kick it to Carly, who's going to talk about stuff that is high on your mind with real estate rental deductions.
And Carly, before you go, I just want to jump in with my 2 cents and say, as complex as this is, BA Harris, you guys have made it really easy for me to do this. And so as a result of your last AVID meeting, I added some more entities and told you guys I did that. And then you did the tax planning for me and told me what to do. And so BA Harris helped me get the EIN, asked me if my profits were different from last year, told me who to pay and when. So really all I had to do was get the business set up and engage BA Harris for tax planning help. And it was great. And it saved me money. So thank you.
Love to hear
and I
that.
just wanted to
Helping out.
Yeah, and I just wanted to point out, we're really harping on the partnerships for rental properties. We just figured that would probably be the most useful for this group. It also works for S corporations as well. If you have a property management company, I know a lot of those are held under or filed under as S corps. Those are eligible for the AVE deduction as well. I mean, we're just kind of using the partnership example because I know that's probably what's going to be the most pertinent for this group. So,
and I didn't know I was being taxed as a partnership back in the day. I just knew I had an LLC. It was a husband-wife LLC, and it was, and then you guys told me, yes, it's being taxed as a partnership and it qualifies. So thank you.
Yep, absolutely. So Carl, you want to take it away?
Yeah, perfect. Oh wait, we have one more question. Do you want to do that before we move on?
Yeah, it doesn't matter where the LLC is formed. Yeah, it's as long as the LLC is formed. The question was, does the LLC have to be formed in the state of Idaho? But yeah, it doesn't matter.
Cool. Okay, so now we're going to move on from the ABE and PTE stuff and talk a little bit more about just some real estate rental deductions that you guys can take on your Schedule E's or wherever you guys report your income and expenses. The one key thing that we have to remember about the expenses is that they must be ordinary and necessary for you to be able to deduct them. Some examples of these are listed here. Some main ones would be mortgage interest and property taxes, professional fees, cleaning, you can see them here. Some ones I want to bring to your attention because some items have changed from last year. Meals are only 50% deductible in 2023 and 2024, and entertainment is non-deductible for both of those years. Just something we wanted to bring to your attention because in the prior year they were 100% deductible. So just a quick change for this year. And then another one that's changed this year is the mileage. You can deduct 65.5 cents per mile in 2023. That's going to increase to 67 cents per mile in 2024. It can't be for all the miles that you drive, but it can be for specific business related miles. Your accountant should know which ones can qualify. And then cell phone and internet are ones that haven't changed. And then depreciation, one thing that we wanted to bring to your mind about one of the accelerated forms of depreciation is bonus, and it has decreased from 100% deduction in 2022 to 80% in 2023. But Congress is also trying to pass a bill currently that would make that go back up to 100%, but it hasn't been passed yet, but it's just something we wanted to keep on the forefront of your minds. And like we said, we gave Stacy a PDF of this. So if you need to know what those rental deductions are, you can always just get a copy of that, and these will be listed out for you. So then we'll go to our next slide, which is our big surprise for you guys.
Brace yourselves.
Yeah. Good or bad, you can decide. So as of January 1st, 2024, there's a new Corporate Transparency Act that has been put into place. And so this is basically every LLC and corporation has to file a form basically saying who the individuals who own control, or at least 25% of the entity's ownership interest, have to report themselves and who they are. So like we were saying, if you have an LLC that holds your rental properties, you have to file this form regardless of your tax treatment, if you're disregarded or otherwise. So what you're going to have to report to everyone is on this form is your name, your date of birth, your address, and a unique identifier number. So basically saying you're going to have to take a picture of your Idaho issued ID or whatever state you're from and upload it on the website. This form is a one-time filing, but if your name changes in any way, or if you move or anything, you have to file another form saying there were changes to the owners. Sorry, there's a question down there. It threw me off a little bit, but we can go back and do you want to answer that right now, Aaron, or do you want me
no, let's just press on, because I know people are going to probably want to know about this stuff. So
okay, perfect. So you can only submit this online. It's kind of similar to the FBAR reporting process. We have the link right there where you would go on the FinCEN website to fill out this form. So it's pretty simple, but becomes difficult if you have tiered partnerships. But if you just have the one, it shouldn't be too difficult for you. Due dates, if your LLC was formed prior to 2024, you have till 1/1/2025 to file the form. But if you form an entity in 2024, you only have 30 days from when the entity is formed to file this corporate transparency form. FinCEN, which is who you file through, is proposing to extend that to 90 days, but as of right now, it's still at that 30, so you have to have a pretty quick turnaround. FinCEN, once again, the person that you file this form through, has recommended that states mandate the filing of the form when you're applying for the entity formation, just so people know about it. Because like we said, it's a relatively like new thing that not a lot of people know about. So FinCEN is doing their best to try to get the information out to the people that need to file. One reason we wanted to bring this to your attention is willfully failing to comply with this may result in up to $500 penalties a day, up to $10,000 for any false or fraudulent information. So you want to make sure that you file everything correctly and on time. And the Idaho State Bar has actually determined that it's a legal matter and a practice of law to file one of these returns. So since as accountants, we are not licensed attorneys, we cannot fill out these forms for you. Of course, we can like monitor and let you know if you need to file one, but we would ask that you go to your lawyer to be able to understand if you need to get it filed and how you need to get it filed. But yeah, so that's what I have for you guys.
Nice job, Carly.
Thank you.
Yeah, thank you. Thank you, all of you from BA Harris. That was absolutely amazing. I know we don't usually do applause via Zoom, but I'm going for it. There it is. Thank you. Thank you for sending the presentation so I can share it with those who've asked, noting who you are. And I know we're going to have some questions. Let's see. Why don't we go straight back to unsharing screens, if you don't mind. Oh, well, no, you might need it for your questions, won't you?
Perhaps.
Are you going to need
Yeah.
your slides for any
Stacy, do you
questions?
have any questions? You always
Okay.
ask great questions.
It seemed to me that the ABE election was a break even from a state endeavor, but it saved you money from the federal standpoint. And it was Kai's question that made me kind of draw that conclusion. Was that correct?
Yeah, you don't really get a benefit on your state taxes. You're just basically prepaying your state tax through your business account or through the Idaho, through your business account through the Idaho TAP website, which gives you a federal tax deduction, which is great because most people are paying more than 5.8% in federal taxes. But yeah, you're not benefiting any on your state tax return because you're just basically adding that deduction back. So yeah, it's basically solely for federal taxes.
Okay. And then another thank you. And another feedback generated question has to do with the surprise. Like, can we add a little glitter to that? I mean, that's not like necessarily a good surprise. Did you find $5 right after you read that report on that new news or anything?
Well, I guess it's a nice surprise if you enjoy speaking with your attorney. If you enjoy going to talk to your attorney, that's always fun, right? Yeah, there's not a lot of upside I can think of. I guess it's for security purposes. I think this is coming about because of FinCEN is mostly they also administer the the foreign bank account requirements. So if you own a foreign bank account with over X amount of dollars, they want to know about it. So it's basically a security thing. So hopefully this leads to a safer country, I guess. If you can put any kind of silver lining on this cloud. We are now we're monitoring this very closely. We're hoping that this gets pushed back. I mean, I know I just recommended for a local veterinarian that she form an S corporation. And I had to tell her that she's going to need to, and she's going to start this year. And I told her she's going to need to file to form an LLC. And I told her, make sure that you keep an eye on this because you have currently 30 days, maybe 90 days to get this filed. And those penalties are stiff. The first time I heard about this, I thought it had to have been an error, but yeah, it's they're not playing around with this. So our
and
plans.
If we have partners, like I have one entity where my partner's my mom, but she's a 33% owner. Or am I practicing law without a license if I file our FinCEN what are we calling it? If I file with FinCEN for the LLC, or am I safe to do that if I'm a member?
So my understanding is if you are a part of the partnership or part of the company, you can file that for someone else, because you're just reporting, because we actually had a partner at our firm file ours, right? And he filed it for the other partners in the firm. It would be an act of practicing law if you were to get somebody else outside of the business to do it for you. But since you're in the business, you can file the form for the company.
Okay. And so for Kai's question that just came in, she doesn't even need to get the form from you. She can just go to that www.fincen.gov/boy website.
From my understanding, from the one person I know who's filed it, who is the partner at our firm, it's really straightforward to get that done. If you're a simple partnership, and that's what was written on the slide. It's pretty simple and straightforward. What gets tough is when you have what's called tiered partnerships, when Stacy, you're a 50% partner, but then another partnership is a 50% partner, and that partnership has partners within it, and then maybe that partnership has a partnership within it. I know there's a lot of large rental properties that we work on who have that exact tiered partnership setup. I'm sure you're familiar with it, Stacy. So those are going to be most likely a contact your lawyer situation, I would think, if this is to go through. So, and you think about how arduous that gets. Now we're talking about every single time one of those partners within the partnership hierarchy moves. Well, now you got to file the whole thing all over again. So we're really hoping this can gets kicked down the road. I'm not gonna lie, I'm kind of happy that we don't have to deal with it. We're actually getting new diagnostics in our software saying, make sure that you're informing this client that they're filing this report. So I'm thinking it's probably here to stay, but hopefully we get a little bit more clarity and maybe some more relaxed rules with this. I don't know. Seems a little arduous to me.
Okay. Yeah, that's a big shocker.
Sure, absolutely.
Yeah. We had another question from Jim and Judy. Does the LLC have to be formed in the state of Idaho, or can it be formed in another state?
Yeah, it doesn't matter. Doesn't matter where the LLC is formed, as long as it's formed before year end, if you want to do it for last year.
Okay. All right. Other questions, folks, or should I move into the recap?
Hey, this is Walt. I just have a question. So if we have, we've got, Cyan and I are probably in 11 syndications or so in different states. And is this something that we need to start asking, our sponsors and stuff to make sure that, we're covered, or whether we need to file them or not?
Are you talking about, you're talking about the FinCEN filing requirements?
Yes.
So as long as these are existing partnerships, they're not due until 2025, but it is worth, I would think, an email or, some kind of a clarification from from these entities that you're in, that they're keeping an eye on it, at least. It's the new entities that were formed as of 2024 that have like the 30 to 90 day requirement. So I think a lot of existing partnerships are, especially if they've got the tiered partnership set up, where it's just going to be like, how are we going to get all these driver's licenses from all these people? I'm sure they are probably taking a wait and see approach with this.
Sorry,
Yeah.
from Aaron, from one of your answer a couple of minutes ago, we don't really own 25% of the business. We are just LP, so small percentage. Probably we don't need to worry about that.
Yeah, that's what I thought too. So okay.
Yeah. Yeah,
I just want to be sure, Aaron.
Well, again, not an attorney. I feel very out of my depth giving anyone advice on any of this, especially because it's so new. I would check out those requirements, and to be honest with you, like, who knows how these are going to change over the next few days. I actually was making this slide a couple days ago, and I updated it for that 80% bonus, and then Congress is now talking about the 100% bonus coming back. So these things, they move around quite a bit.
Yeah, regarding that 100% bonus depreciation coming back, where did you hear it? What kind of chances are they go through again?
I mean, if I could tell you what Congress is going to do, I'd be a rich man. But I would assume that 100% will come back. It's my thought. But we don't know. It's impossible to tell.
Yeah, because I was single family, over the years, the CPA did a straight line depreciation. So we never took advantage of it. But for apartments and the bonus depreciation does help a lot if you hold for several years only.
Well, bonus depreciation is limited to items that are under a 20-year property and under. So you can't take bonus depreciation on, say, the building itself. It's
right.
So
it's they do cost segregation
cost
first.
segregation is exactly, that's when they really come into play. Yeah. So hopefully, I mean, I hope it comes back, but we'll see.
Thank you. I hope so too.
Yeah, job stability, keeping the tabs on this kind of stuff.
Okay.
Hey, this is Leah. Can I ask a question real
Yes,
quick?
please.
Yeah. Okay. So this is a newbie question here. So me and my husband formed an LLC last year. But our rental property that we just purchased is definitely not going to be generating a profit in 2023. So is that an issue with having an LLC? Do I have to file separate taxes? Because we were kind of planning on having losses that would deduct against our ordinary income. Or am I thinking about this all backwards?
So without knowing exactly all the details of your situation, no, you don't have a problem filing with an LLC. I mean, I'm assuming that you're going to just report this on a Schedule E. There's no issue with the LLC. Depending on your level of activity within the property, are either you or your husband a rental or a real estate professional?
No.
Okay, so rental activities, the standard treatment for that income and loss is passive activities. So depending on your level of income, you can deduct up to a certain amount of your losses, because passive losses will be limited to passive income in most cases, unless you make under a certain amount of income. But yeah, I mean, depending on your net income, if your net income is too high, you won't be able to take deductions for your passive losses.
Okay. Sounds like I need an accountant.
I mean, I know of one.
Yeah. Well, thank you.
What was that?
I said you beat me to it.
No, again, not a salesperson, but
Any other questions out there? All right, Aaron, if you can stop doing the screen share for a minute, we'll get all the faces back. And if you guys think of a question, that's fine. But I'm going to do a little recap because it's always a lot. And you guys know, I take the notes. Well, first of all, BA Harris, Aaron, TJ, Madison, Carly, thank you guys for all being here online to help educate us. Even though you don't always give us the best news that we want, we really appreciate you helping us make smarter decisions. And what I heard today that really stood out to me is the only non-controversial election that out there right now may very well be the ABE election, which stands for the affected business entity election. And it avoids that assault on your deductions by allowing you to write off the state income tax that you're paying on your net rental income, which is 5.8% in Idaho, 5.8% of those profits. So if this is something that you think you want to do to really oversimplify this, it requires a few things. Well, first off, it requires income. You need to have enough profits to make it worth it. It requires the right kind of business entity that would qualify. And then it requires making that ABE election and then doing some tax planning. And so for that, I think it requires an accountant, but that accountant's going to remind you to basically be on time with your payment by year end or March 15th, to pay it from the business account. And to do that, you're going to need an EIN for your business account. And so if you qualify by having that rental income, this ABE election can really make a difference and help you make some really decent write-offs. Other outstanding information was we're back to only getting to write off 50% of the meals this year. Our mileage rate for 2023 is going to be 65.5 cents per mile. And then that goes up in 2024. And then the big surprise, the federal government is insisting that every LLC has to file a form online form reporting members, their name, their date of birth, and some identifiers so that they know who's in the LLC. So we got a good link for doing that. And you've got a lot of time to do it if your LLC was not filed, if it was filed in 2023 or before, but you're going to forget. So we better just do it. Otherwise, if you're filing an LLC or starting a new LLC, you've only got 30 days. So we definitely all have an action item if we already have LLCs out there. So what did I miss? Aaron and team, anything to add to that? I'm StacyA McBain with Swope Investment Properties. And I appreciate you AVID investors for joining us tonight and zooming in and staying safe since the weather's crazy today.